Hello and welcome to episode 289 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leaks. Damien, how you doing?
I'm really good, Andy. We gave out a mug this week. I just wanted to highlight that at the start of the show because we do sometimes mention, don't we, that we give away mugs to people who do things mug worthy. And one of the reviews that we read out, I think it was on last week's show, the person got in touch and said, "That's me," via Facebook. That was me. And they're now the proud owner of a new mug that's winging its way to them. So that's good to see. I like that. And so the reviews are coming in. There's a really good review that I've just seen before we started the podcast, talking about how we are an integral part of somebody's financial journey. So that sort of thing you can hear makes me happy. So keep sending the reviews in.
Yeah, and so it should, Damien. And if anybody out there is thinking to themselves, do you know what, I love this podcast, I must get round to that review, do it, because you could be a mug better off. This time next week, you could be drinking that coffee. And it's always nice to hear back from people, whether it's reviews or actually we heard back regarding last week's podcast, talking about hearing back from people. And we had some good feedback, didn't we?
Yeah, on the roundup piece in particular, I think people found that really useful. So that was via Twitter. So that was really good to read. And in fact, a lot of the brands suddenly got involved that we were talking about. And some of can you hear my cat, Andy?
No, I've just had to silence my mic because my dog's going crazy.
I mean, this probably won't appear on the podcast, but Andy's got a dog at his end and I've got a cat. My beloved cat is crying at the door because I'm at home doing the podcast today.
I've got exactly that. My dog's trying the door and crying.
Yeah, so I'm going to have to let the cat in, but I'm not sure. Hold on a second, Andy.
I don't know what it says about you and I, because your cat wants to come in. My dog wants to get out.
I'm going to just leave her. She'll settle down eventually. So if you hear the cat, she's happy. She's not distressed. She just wants to come in and sit on my lap while I record the podcast, which we cannot do. She's distracted. And she's also been sick on me the last 3 nights in a row in bed. So anyway, as I was saying on the roundups, it's great to see the feedback. They were actually, the person mentioned the brands that they liked or used and the difficulties, etc. And some of the brands actually started to engage with that, which is always nice to see the influence we have. But one of the quirks I've started to notice from now beginning to use one of the Roundup apps that I mentioned is that some of them round up even if you spend exactly to the pound. So if you spent £3 on a meal deal in your local supermarket, then it would round it up to a full £1 if you do that. And if you double boost it, then it would be £2. So actually what it means, and why I'm mentioning it, is this week I've started taking more of my own food in. So taking lunch to the office, because if I don't, then rather than the £3 come out of my bank account, it actually cost me £5 on the roundup included. So it's actually encouraging some good behaviour to try and not use my card as much, which I'm not sure if that's slightly counterproductive or not. But anyway.
Actually, Damien, funny you should say that, because I think I know the app that you're talking about, because I was playing around with the same app myself and I managed to find deep into the settings that there is a little a setting there that you can toggle on and off the roundups from round numbers. And so I've actually turned mine off. So, yeah.
See, I'm even learning on this podcast, which is fantastic. So I might do that. It means I can then go and buy lunch at lunchtime. I tell you what, I'm also chuckling because I did hear your dog in the background. So your dog and my cat are still communicating via the medium of podcasts. On this week's show, Andy, I'm going to go straight ahead with it. It's got a focus or a theme of a second wave of the coronavirus. Now, you could not avoid hearing that the second wave of the coronavirus is on its way. It's hit the UK. It's already in Europe. There's been various lockdown measures over there, stricter measures in this country. We've hit 200,000 deaths in the US. So the second wave is upon us. And so it will have financial implications. So what I'm doing is an investment piece about how to diversify your portfolio for a second wave of the coronavirus. Because if you recall, the first wave of the pandemic had a huge impact on investment markets. In fact, we saw one of the fastest bear markets in history. The market collapsed in February to the beginning of March. So what can investors do to try and diversify their portfolios if the second wave is severe and causes another market sell-off? I'd have to talk about something that is very contemporary and timely. The new job support scheme that was announced this week. I could not do a money podcast and not mention it. So the government announced new measures to support employed and self-employed people. So I want to just mention some sort of high-level details on that. It does date the podcast if you're listening to this in 2025, but bear with us. And then the final piece I want to talk about, again, we're all going to have to work from home more often. And one of the unfortunate outcomes of that is that we use more energy at home, but you can claim money for that. So you can actually claim back a tax relief effectively. So listen to that, how everybody pretty much could claim some money back from the taxman. So it's definitely worth listening to.
Great. So what are we going to start with this week?
So the thought process behind this piece is diversifying your portfolio for this second wave of the pandemic. Because if we look back at the first wave of the pandemic, investment markets took a big hit. So we saw equity markets plummet more than 30% in a lot of cases. We even saw bond markets wobble. So trying to diversify a portfolio is quite difficult for an event that is effectively a black swan event, something we couldn't foresee happening. And if you go back to February, March, and you look at how investment markets moved, or just from your own memory, when you looked at your own portfolio, you would have seen that the assets across the board started tumbling, and it was very difficult to see what was going on. There's a lot of panic. A lot of investment commentators were running for the hills, diving into cash, or not knowing what to invest in or what they could do. The second time around, we've got this second wave coming. We can learn from what happened in the first wave. So we can learn about how assets reacted during that first pandemic. And if we base it upon the assumption that the second wave will probably follow a similar pattern to the first, the sorts of things that will benefit, the sorts of behaviors we'll see from investors, the sort of fear, the greed, all those things, when they're wrapped up, we can learn from what happened before and try and diversify our portfolio. So what I did is, for 80/20 investor members, this was a piece of research that I published at the back end of the week that looked at how you can diversify your portfolio, looked at the 36 different sectors that exist in the unit trust universe that cover a range of asset classes. So they cover equities, bonds, property, cash. I even threw in gold as it's not a sector, but looked at a gold ETF compared to those asset classes. But within each of those asset classes, I looked at geographical differences. So Japanese equities, North American equities, European equities, UK equities, global bonds, UK gilts, emerging market bonds, and the different categories within those, and looked at those and saw how did they behave in the lead up to the crash and up to that low that we saw on the 23rd of March. And by doing that, you can then see how different parts of a portfolio reacted and how to possibly construct one going forward. So I looked at something called correlation. Now, if you've listened to this podcast before, correlation coefficient is a statistical measure that I love. It's a very simple thing to use, but a complex thing to work out. But effectively, if you get two assets and you can work out a statistical measure that defines how they move in relation to each other, and that statistic is measured between -1 and 1, and 0 is obviously in the middle. If they have a correlation coefficient, I'll just say correlation of 1, that means they move in lockstep. So if one moves up by 1%, the other one will move up by 1%. If it moves up by 10%, the other one will move up by 10%. If it is a -1 correlation, so that is perfectly negative, that means that when one goes up by 10%, the other one will tend to go down by 10%. They move in opposite directions perfectly. Of course, you've got a gradient through that range from -1 to 1. Once you hit 0, that means the two assets are uncorrelated. There is no discernible relationship between how they move. They move independently. So what I did is I looked at all of those asset classes and did a heat map. So if you imagine a heat map where you've got all the assets along the top, all the assets down the side, and then you can look at that grid and you can see a color coding to see that correlation between the different asset classes. So you could look, for example, and go, well, if I've got a lot of my portfolio invested in US equities, or let's say US technology stocks, because they've been doing really well, what would happen if we had another wave of the pandemic based on what we learned from the first wave? And then you could have a look and see which asset classes were correlated with US technology stocks. So when US technology stocks slumped, which asset classes followed them downwards, or which ones moved in the opposite direction, or which ones just did their own thing, so uncorrelated. In an ideal world, when you diversify, you would like to have a range of assets within your portfolio that aren't all doing the same thing. So their correlation isn't all one. They're not all perfectly correlated. You want ones that are moving in the opposite direction, ones that are moving independently of each other. So obviously on the podcast, I can't tell you all the details of that map. It just doesn't work in a audible medium as a podcast, but neither would I want to give it away because 80/20 investor members obviously pay for all that stuff. So if you want that heat map, sign up for a free trial. You can see it and you can use it as a crib sheet to say, yes, I've got this particular exposure in my portfolio. Actually, my portfolio, if we have another wave as bad as the first, could be at high risk of all moving in the same direction, collapsing at the same time. Maybe I want to try something a bit different in there. But I want to pull out the highlights. And I also, alongside looking at what happened in the 6 months leading up to that market low and the slump, looked at what happened in the 6 months afterwards, so the rally we had. And it showed the correlations between asset classes have increased in a positive direction in the last 6 months. So we are at a point now where nearly every asset class is positively correlated to quite a strong degree, which means that if we do have a market slump because of the coronavirus spikes again and we have another big wave, then the risk of a slump in nearly all asset classes is quite high, like it did during the first wave. Interestingly, when markets move really aggressively because of a sell-off, what we tend to see is in a very short space of time, say like a couple of days, that volatility will really spike and all assets do actually converge in terms of their behavior. So they all fall or they all rise. It's just blind panic as people jump out of any asset class, whether it's bonds or equities, and dive into cash. But then across the lifespan of that sell-off, then you start to see some of the correlations emerge. So you start to see things moving in different directions. And that's what the analysis I carried out showed. And interestingly, most equity markets are correlated during that sell-off. So if we get another wave, they all move in the same direction, as you probably would expect. But there are some that didn't move to the same degree. There are some that were less correlated, and that was in particular Chinese equities. So if you looked at technology stocks or North American equities and compared their movements to Chinese equities, then there was not much of a correlation between the two. It was unusual, in fact. And it was to a lesser degree, we had the same thing in Asian equities. So Chinese equities, if you'd held them during the first wave, were quite a good diversifier against other equity markets, which you wouldn't normally expect to see. So why is that? Well, if you think about it, they had their first wave of the pandemic a bit before everybody else, but they actually controlled it better. And in the rest of the world, the pandemic really got out of control, and we're seeing that second wave. We're not seeing it to the same degree in Asia quite yet. So I'm talking about China in particular. So even in the last week or two, markets have started to worry about the second wave. We started to see some of the movements we saw in the first wave in terms of asset classes re-emerge in the second wave. So by that I mean that Chinese equities to a certain degree have been outperforming American equities. They've been moving in different directions. One's going down, US equities, but Chinese equities haven't done. And the same could be said of UK equities versus Chinese equities. So it's something to look at, something you wouldn't have necessarily expected. If you want uncorrelated asset classes, then have a look at UK gilts and index-linked gilts. Now, if we go back to the Perfect ISA portfolio on episode 278 of this podcast, I did an all-weather portfolio review. I looked at those portfolios that were meant to weather any storm. Interestingly, UK gilts appear in the Perfect ISA portfolio that I've talked about on that show and previously. And UK gilts can feel pretty boring and they don't necessarily always do anything. They can be quite volatile, but in terms of boring, I mean, in the last few months, they've not really lit the world alight, but they can provide a good diversifier, particularly for UK equities, but also for overseas equities. And that was borne out during the sell-off earlier on this year in that first wave of the pandemic. Now, global bonds, you might think, yeah, bonds versus equities, they're good diversifiers, but global bonds to a lesser degree were good diversifiers. And I'm not going to give it away on the podcast, but certain global bond classes were better diversifiers than others. And to give you a hint, so you can go and look at it and you'll notice it, those that had exposure to the US dollar did better because the dollar becomes a haven typically during times of stress. So that means that people rush to the dollar, they buy dollars, and particularly obviously US investors. And when the dollar strengthens against other assets, those asset classes that benefit from a strong dollar tend to do well. So keep an eye on that. If you want an asset class that was negatively correlated to almost anything that was out there, funnily enough, gold was one of those. Now, gold tends to do well when the dollar falls or is weaker, but at the same time, it tends to do well when you get periods of extreme fear. So that's what we saw in the coronavirus panic. Initially, it sold off like most assets, but then it recovered. So gold was a good diversifier during the first wave of the pandemic, and it could well be during the second wave of the pandemic. We'll have to wait and see. Interestingly, direct property. So those property funds that you've heard about, those unit trusts that are now all closed because they've become almost illiquid because there were people trying to pull their money out in panic, and obviously you can't sell an office block very well in a day. It means that they had to close them so people to protect the investors that are staying in there. So they have been good diversifiers, but you wouldn't want to hold one. So you want to avoid that. Cash, of course, was king during the sell-off. It always is. But so that diversifies your portfolio. But in the long run, you can't just keep holding cash, otherwise you make no money. If you held cash all year, you'd have lost out on the rebound that we've seen in the last 6 months. Targeted absolute return funds, they weren't particularly good diversifiers during the sell-off. They tended to perform with a positive correlation to equity markets. So although they're marketed as this fund, these group of funds that are meant to try and make absolute returns in almost any market conditions, reality shows that they don't really do that. So don't rely on absolute return funds as a group. I'm talking about these sectors as a group. Within individual sectors, there are nuances, of course. There will be funds that behave very different to other members of the same sector. But as a collective in each sector, targeted absolute return funds aren't the best diversifiers out there. So the message of this part of the podcast is the risks are rising if we have a second wave, and that the market could indeed have another wobble. If it does, the lessons learned from the first one suggest that equity markets almost universally will fall in tandem. Chinese and Asian equities might provide some diversification benefits, but you will need to probably look towards certain parts of the bond market. Not all parts of the bond market will diversify your portfolio that well. Certain parts, particularly UK gilts, seem to do the job. They are volatile at times themselves, but they have tended to do well during periods of extreme stress in that first part of the pandemic. Emerging market bonds don't tend to do as well, but look for parts of the global bond market that do well when the dollar rallies. So that's giving you a big hint there. Try and avoid absolute return funds. They don't live up to their name. Cash, of course, is king, but as I said, it won't do much for your returns in the long run. And gold is an interesting proposition. Now, I do hold some gold in my own 50k portfolio that I have on 80/20 Investor. It's a volatile asset, but in times of extreme stress, it does tend to offer some diversification benefits, but it's not a given. It's not in all circumstances, but year to date, it has done very well indeed. So go and have a look at that research piece if you are at all interested.
Lots of interesting stuff. It's interesting to hear about those targeted absolute return funds. You always hear about those being the absolute winners, but clearly not. And it's good to see you've done the research on that. As you say, check out 80/20 for the full piece on that. Okay, so moving on then, we're going to be talking about the job support scheme. So there's been a lot of change and a lot we need to update people on. We don't like to focus on these. It's not an evergreen piece, but it would be remiss of us not to mention it.
Yeah, exactly that, Andy. And so I just want to run through some highlights of what was announced this week. We had the furlough scheme. So people previously, if you were employed, then in sort of high level, you could get 80% of your wages paid for by the government if you stayed at home. Now, that scheme has been in a state of flux as the government is trying to wean us off of that scheme. And now the government has realised with this second wave coming, and they've held their hands up and said it's coming, they need to do something to try and help the UK economy. And they didn't want to extend the furlough scheme because their view was that some of these jobs aren't viable. They kept using that word viable. So they clearly felt that there are jobs out there that are only surviving in existence because the government is paying the wages or has been paying the wages. And so they're pulling the rug from that. So rather than pull the rug away completely and see a mass wave of redundancies, they've instead tried to incentivize employers to bring people back into work part-time and carry more of the burden as employers in terms of paying for those wages. So just to remind people, the furlough scheme is ending in October. And what they've decided to do is replace it with a scheme that will pay 3/4 of people's salary for 6 months going forward. And the aim is to try and limit the number of job cuts that are going to be on their way, because we've got to be realistic. There's going to be a big wave of job cuts coming now the furlough scheme has finished. And the main point of this scheme is that what will happen is it will apply to staff who work at least a third of their normal hours. So if you imagine you were going back to work part-time a third of your hours, your employer will pay for those hours that you're going to work, but they will also pay for some of the hours that you don't work. So for the hours that you aren't working, the government will pay for a third of them, and then your employer will pay for the other third. So you can see the employers are taking more of the burden. Now, the government contribution is capped at £697.92 per month, which is incredibly exact. And it's only available to small and medium-sized businesses. So the really large businesses out there are going to have to prove that their turnover has fallen as a result of coronavirus. So again, this is trying to pull it back. So it's only the smaller businesses and the medium-sized businesses are benefiting from this scheme. And I have to just point out, you don't have to have been on the furlough scheme to be part of this. Now, there are lots of caveats that you have to be on the payroll before the 23rd of September. The government money is paid in arrears and reimburses employers. It doesn't cover Class 1 employer national insurance contributions or pension contributions, and employers will have to keep paying those. So there are these nuances of it, and it is in conjunction with the job retention bonus that they also announced. So they announced a £1,000 bonus for each employee that an employer brings back to work by the end of January. And the idea is that that scheme gives a cash incentive to keep people on under this new proposal, rather than just think that making people redundant is the best and cheapest way. Now, whether that will turn out to be the case and be taken up in large numbers, we'll have to wait and see. But the message is that people should be having a conversation with their employers about the new scheme that's coming into effect. So if they're furloughed, this new scheme will be replacing it, and they will be expected to go back to work for at least a third of their previous hours, and then they will be able to earn up to 3/4 of their previous wages. So there is some light at the end of the tunnel for people who are employed. Now, I know people will be thinking, well, what about the self-employed? Now, there were some things announced for self-employed people. They've tried to do something vaguely equivalent to help self-employed people. So if you remember previously, if you suffered a loss of income, there was a taxable grant that was paid to self-employed people worth up to 80% of their profits, and it was capped at £2,500. Then over the summer, there was a second and final payment was announced, which covered 70% of their profits, up to a cap of £2,190 per month for 3 months. So now what they've done is included fresh support for self-employed people, but it's obviously less generous. So there'll be a taxable grant at the start of November that covers 20% of the average monthly trading profits, and that will be paid out in a single instalment covering 3 months worth of profits, with a limit of £1,875 in total. And there will be a second grant that covers the 3 months period from the start of February 2021 until the end of April, but the amounts haven't been set. So there is something there for self-employed people. There were some changes to the bounce back loan scheme, enabling people to repay the money over a longer period of time. So we're going to link through on the show notes to the full details that we've pulled together in an article, so people want to read out more, and other resources they can go to and look at the fuller details on the .gov.uk website. But the message is that things have changed. There is a bit more support out there. It's not going to help everybody, clearly, and there will be people who fall through the gap again. But in case people have missed it, go and read the show notes, go and look at the links, and you can find out a bit more information if there's anything out there that can help you.
Great stuff. And the final piece kind of links back into that piece as well. Obviously, with the coronavirus and everything else, more people are working from home if they can do so. And there's a little bit of good news here that people can claim back some extra money.
Yes, so this is a tax relief that some people might not even know exists, and really has come to the fore because of people being required to work at home because of the coronavirus. But if your employer requires you to work from home, then you can claim for the increased costs of heating and electricity, because that's inevitably going to happen when you're using your computer, etc., and working at home. Now, this has always existed. This isn't a coronavirus thing. It's just that more people now are eligible to claim it. Now, it's difficult to apportion those extra costs directly to the work that you do, but you essentially can claim £6 a week back in costs. And now there's a simple way of doing it, and there are two ways you can. So your employer can give you £6 a week extra tax-free, and that would be the simple way they could do it, but that's unlikely to happen in reality. We're in a period where employers are obviously struggling because of the coronavirus. Asking for the extra £6 a week tax-free it probably won't go down too well with most employers, but you can claim it as a tax relief on that £6 a week. And the way it works is that you get tax relief at your marginal rate. So let's say you are a 20% taxpayer, then what would happen, rather than get £6 a week, you get £1.20 a week, 20% of £6. If you are a higher rate taxpayer, then you'd get £2.40 a week in tax relief. Now, that doesn't sound like much when I say the numbers on a weekly basis, but if you were a basic rate taxpayer, that works out at £62 a year. If you were a higher rate taxpayer, that's £124 a year. Now, straight away, people should be sitting there thinking, hold on a second, this is probably like equivalent to somewhere heading towards a month energy free if they reclaimed the tax relief. Now, HMRC says that as long as you are claiming in line with that £6 a week, so you're claiming the tax relief, for example, in line with a £6 amount, then you don't have to provide any evidence whatsoever for the usage of that energy. And you can even claim it if you are part-time. So the message is, if you are working from home, like a lot of people who work in offices are now forced to work at home, there is a tax relief here that you can claim legally, which could be helpful. Now, how you claim it is you can claim it via self-assessment, or you can do one online, which we will link to in the show notes, or you can do it via post. But you'll need details like your employer's name, PAYE references, national insurance numbers, but it's simple to complete. And it begs the question, why wouldn't you if you've been forced to work at home? Now, the other thing I would point out is that it's retrospective, so you don't have to rush to make the claim today after you've listened to this podcast. So if you're going to be working for a period of time at home, you can then make that claim once you've gone back to work full time. And what will likely happen is you won't necessarily get a cash lump sum back from the taxman. They will adjust your tax code and you'll get the relief that way. But in the long run, it amounts to the same thing. So there is £62 a year on the table for basic rate taxpayers, £124 a year for higher rate taxpayers. Hopefully, we're not going to have to be working at home for anything like a year. But if it's there, you're entitled to claim it. Why wouldn't you? Oh, and one thing I did forget to mention there, even if you only work at home 1 day out of 5, you can still claim the full £6 allowance. So, yeah, as I said, it's worth looking into.
Good stuff. If you want to get in touch with Damien, you can do so. It's Damien at moneytothemasses.com. Twitter, it's at moneytothemasses with the number 2. Don't forget, we're on Instagram. We've got a Facebook group as well, facebook.com/groups/money to the masses. We've had another surge of people join that group this week and ask some really, really good questions. And if you want to get your question answered on the podcast, a good place to do that is to head over to the group and start the conversation. And if it is something that lots of people are interested in, it's very likely we'll cover it at some point in the podcast in the future. As we said at the beginning of the podcast, don't forget, do please review our podcast. It could be mug worthy and a mug could be winging its way to you. Damien, I think we're done, aren't we?
I think we're done. Is your dog still alive, Andy? Because my cat, I don't know where she is. She stopped. I might go and creep and open the door in a second and see if she's sitting outside. But yeah, she's walked off sulking now. She's probably gone and curled one out on my bed in disgust.
Can we put that in?
She has been known to do a dirty protest.
Great stuff. So until next time.
Until next time.